Okay, everyone, we're going to get started here. So thank you all for joining us today. Welcome to the Colorado Self-Storage Association's Q&A investment webinar. We're going to move this webinar along at a very quick pace to make sure we're mindful of the audience's time and also make sure the energy level of the webinar is appropriate. At any time during this webinar, and if you want to ask a question, please do so by typing your question into the toolbar icon that looks like a bubble at the bottom left-hand side of your screen. We have received several sets of questions over the last several weeks, and we're going to do our best to get through as many as possible. But if we don't get to your question, please follow up with me after the call, and we will make sure to get you feedback from all the panelists. I'm sure many of you have sat in on several webinars over the last several months to try to get a feel for how the market is doing in light of the COVID disruption and how the self-storage industry is performing. The fact is that the self-storage industry market is very fluid today and changing rapidly. So we're hopeful that we can provide you guys some guidance today on where we're seeing the Colorado self-storage market and also some best practices today. Colorado continues to be one of the most dynamic self-storage markets in the country, as we've recently seen a large amount of new facilities open, and there are still transactions happening. Today we have a very distinguished panel. Many of them don't need introduction, but in an effort to make sure we're all on the same page, I'm gonna introduce all of you here shortly. First, on my screen, the bottom right hand is Tom Razo. Tom has been a developer and contract in the Colorado market for over 30 years. Tom is the president and CEO of TRC Company, and he currently owns many self-storage properties, and his portfolio consists of more than 17,000 units. He's also involved in the retail, multifamily, and office markets. Tom has been intimately involved with all of the entitlement, design, and construction of his portfolio over the years. He has also been a board member of the Colorado Self-Storage Association for several years. Jon Suddarth is with us today. Jon is the Vice President of Real Estate at the William Warren Group. Jon is responsible for the management and oversight of their Denver office. Jon has been involved with 19 self-storage developments and several acquisitions in his time at William Warren. Jon is responsible for new development and acquisition opportunities in Denver, Seattle, Portland, and Austin markets. Hank Saipe, who is an industry veteran, has begun his career in commercial real estate as a broker in the 1980s in the Denver market. During the 1980s, one of his largest clients was Public Storage. Hank was able to locate more than 20 development sites for public storage around the Denver market. In the 1990s, Hank ventured out on his own and started to develop his portfolio for his own account. In 2020, Hank is celebrating his 25th year anniversary from his first self-storage development. Hank's portfolio consists of over 3,900 units around the Denver metro area. Hank is also a founding member of the Colorado Self-Storage Association. And last but certainly not least is Mr. Kinder. Jeff has been is not only a board member of the Colorado Self-Storage Association, but also the Maryland Self-Storage Association, and has been in the self-storage industry since 1986. During Jeff's self-storage career, he spent 2 years with National Self-Storage in Tucson and 10 years with Public Storage, mostly in Canada. Today, Jeff is the president of Advantage Advisors that operates under the brand Advantage Self-Storage, with several self-storage assets in the Northeast, Mid-Atlantic, Florida, and Rocky Mountain West. In addition to operating his own portfolio, Advantage has been providing direct investment, syndication, and property management services to individuals, companies, and institutions in the self-storage industry since 1997. Jeff's reputation as a mainstay in the self-storage industry is unparalleled. And for those of you that don't know who I am, my name is Ben Vestal. I'm the president and CEO of Argus Self-Storage Advisors. We're an industry-leading self-storage investment advisory firm that has been exclusively focusing in self-storage for the last 25 years. Because of the recent market disruptions due to the COVID coronavirus, I'm going to start by having each of the owners operators that are on the call today comment on their portfolio's performance and best practices. Why don't we start with Jeff? Jeff, can you talk a little bit about how you've navigated COVID disruption over the last 60, 90, and 120 days, and how what you're doing and how your portfolio is performing?
Sure. Ben, first of all, thank you for that very generous introduction. That is much appreciated. It's interesting to see how this one is playing out. Having been in the industry since 1986, 1987, we've seen a lot of peaks and valleys that have happened, and this one is actually somewhat unique in the way that it's going. Most of our stores are along the East Coast, with a few each in the Florida, DC, New York, and Boston areas. And in fact, our management division is still based in Maryland. I personally managed to escape the East Coast about 12 years ago and moved to Denver, and I'm still very grateful for being able to be out here. Besides managing the couple stores that we have here in the Denver area, we're also developing another one right now under construction in the Layton Rock area, Candelas area of Northwest Arvada. It has really been interesting times throughout all the markets. They've been a little different, but some things are similar, and it's been interesting. The overall impact on the bottom line has not been as scary as what I would have thought it would have been in March. Certainly our move-in activity, January was fine, February was slow, but by mid-March through the middle of May, things were dead. By the middle of May, we were down nearly 20% year over year as far as move-in activity in those stores were concerned. Fortunately, the last week of May, things began to open up again. And May and June were both, the last week of May and June have both been good months, good weeks as far as move-in activity is concerned. So by the end of the June, instead of being down 20%, year over year activity by the end of June, the first half of the year ended up being in move-in activity down 8.3%. The other side of the coin is, though people were really frozen in place, our move out activity is down 28.6%. So that's left us with a net gain, actually, year over year of the 46 units. And with that net gain, we've actually been able to hold our pricing. In fact, our street rates at this point in time, surprisingly to me, are actually up 3.4% year over year. What that actually means, I guess, on a more tangible level, is that our 10 by 10s are ranging from $145 to $170, depending on which store and the unit type that it is. Effective rates in our stores right now are in the Denver area are about $1.20. Also surprising to us is that our delinquency is actually down by about a quarter of a point. In spite of the fact that we continue to wait until people can't afford to pay anymore. I think that the combination of the fact that we're an event-driven business, that move-outs have been dead, and that the events that bring people to self-storage have somehow kept us being a priority for our customers. This is, I don't want to say it's a non-event, but I am grateful that I'm in the storage business, because it has not been catastrophic for us. Obviously, we're limiting access to the office, we're limiting office hours, we're limiting the amount of staff that's on site. Our online move-in activity, our online payments, all of those have increased significantly. And somehow or another, it still keeps getting done.
Thanks, Jeff. That's a great overview. John, I know that William Warren operates almost 200 assets around the country. Can you comment a little bit about how the William Warren portfolio is doing? And I know you have some new stores here in Denver, and how your Denver portfolio is doing. John?
Yes, certainly. Can you guys hear me okay?
Yeah, just fine.
Great. All right. Well, yeah, thanks for the time. Thanks for the intro, Ben. I don't have quite the experience that the other gentlemen on the call do, but I have been a board member for a long time. I'm a vice president of real estate at WWG, or William Warren Group, as Ben referenced earlier. I've been with the firm about 7 years. One of the original members on the real estate team, based here in Denver. We're a Santa Monica, California-based company, but we do have a Denver office here in the Denver Tech Center. As Ben alluded to, we have nearly 200 stores nationwide. I believe around 190 at the moment. 12 million square feet nationwide. We have roughly 30 stores, going on 30 stores in the Denver metro area, which I believe would make us the third largest after Public Storage and Extra Space. That includes both managed and owned stores. We're building 2 more at the moment. We're nearing completion on a store in Boulder. It'll be the second store delivered in the last 13 years, I believe, in the city of Boulder at Foothills and Pearl. It's a small store, about 40,000 square feet. And we're also finishing construction or under construction and about halfway through on a project out near Pena Station at 60th and Tower as you're driving out to the airport. It'll have the more traditional drive-up units. So with regards to our performance here in Denver, we are actually, it's been a roller coaster of a ride, as Jeff alluded to. Our move-ins are actually down, as similar to Jeff. Jeff, I think you said you guys were down 8% year over year. We're down 3% as of July 15th, yesterday. Net move-ins, or gross move-ins, excuse me. But the move-outs are also down roughly 10 to 11%. So our net is up 8%. Jeff, I heard you say your move-outs were down 28%. But what that tells me is that people are not wanting to go to their storage units unless they have to, which kind of makes sense, because during a lockdown, if you need a storage unit, you're going to go out and do it. But if you don't have to go to your unit, you're not going to. So I was talking with our operations team earlier this morning, and we think that the actual visitations to the store are probably down. We don't track that. I don't know anybody that does track year over year visits to the store, but my guess is they're significantly down unless you have to go to your unit. With regards to ARs and delinquencies, Jeff, you guys said you guys were about flat year over year. We were at one point, we were at 5% of delinquencies, and typically that's about 2.5%. But as of now, in the mid part of July, we brought that back in line with historical norms around 3%. So we're doing well on that front. Lastly, with regards to rate, January, February, March, we were pretty much even versus 2019. But April and May, we saw significant decreases because people weren't really moving in. So we were down 12% in April, 19% in May. But then in June, we've bounced back again, and we've really experienced some strength. June and July, in the last 30 to 45 days, the market's outperformed what we had expected it to be. Within the certain submarkets, interestingly, Parker, we have 3 stores in Parker, and I was speaking with our district manager, Michaela Welch, this morning. Michaela indicated that our Parker stores are doing relatively well, being quite resilient in spite of all the new supply in that submarket. Whereas in Aurora, which hasn't had quite as much new supply, our stores are, down a little bit more than you would expect without a whole lot of new supply. So I don't know if that has to do with the employment trends in those areas or what's going on, but that was kind of something interesting that I found. As far as our new lease up, and then I'll stop talking and pass it along, but as far as our new stores and lease up, the DTC store here in the tech center, we're mid 80%. We've been open there for 3 years. Some of our other assets, we haven't really struggled filling them up. It's just been the rates at which they filled up that's been the bigger issue. You pro forma them to come in much higher than where we've achieved so far. But we think that if there's fewer new stores being built, which at one point 3 years ago, Ben, you and I have talked about this several times, there was 82 stores in the Front Range, either planned or under construction, 82. This was 2017, 2016, 3 or 4 years ago. But now most of those stores are built, and I was only aware of, we were only aware of 6 stores from Fort Collins to Colorado Springs that are either planned or under construction, and 2 of those I just mentioned at the beginning of my presentation. So with that being said, I think things if we keep the new supply low, if we don't go out and keep building as much as we have in the past, I think the market will rebound because the population continues to come in for quality of life. But with that, turn it back to you. Thank you, Ben.
Yeah, thanks, John. I think we're going to talk a little bit later on in the webinar about rates and kind of how the Denver market has struggled to hold rate. But Hank, can you talk a little bit about how your portfolio is held up? I know you use Cube and Extra Space as a third-party manager, and we'll move on to Tom, who uses all 3 of them after you. But can you talk a little bit about how your portfolio is held up and some of the best practices and how it's performed, Hank?
Yeah, three of my properties are in Denver. I got one in Arapahoe County, one in Jefferson County. And we've been, I don't want to make light of this virus because it's very serious, but 2 years ago, when the oversaturation of the market, I mean, was more impact on our occupancy on rental rates. This year, when the virus hit us, I made a point of closing our stores quicker than CubeSmart wanted to. And we just wanted to deal with people on the telephone or through the door, something like that. And we did that, and then CubeSmart and everyone else picked up on that. And obviously that was by law that, we had to limit the amount of customers who were in the stores. And our impact was really, we lost no business at all. Year over year, we're up 4% in occupancy. Our rental revenue is up just slightly, like 1 or 2%, depending on what store. The biggest impact I had was my property closer to University of Denver at Broadway in Mexico, and that's 92% occupancy on the low end, and so we're doing well overall. But it's really, what John was talking about, the oversaturation market that happened a couple of years ago was a bigger impact. But what we have down the road also, August 1st, people are going to stop getting their $600 extra payment on unemployment. And I don't know what impact that's going to have on us. How many people are, I was just reading an article today in the Journal about how many people are going to probably be in default on their apartment rents. So I don't know what's going to happen in the future. Right now, I think I'm feeling pretty strong, with what I have and the position we're at.
Thanks, Hank. Great overview. I'm glad to hear you're doing well. And I think the point's well taken that you mentioned there about, I think that there's a disconnect between the investment market and also the economy. You see that on Wall Street. The stock market continues to do well when there's meaningful hardship being had by consumers out there. So, Tom, can you now, you have one of the larger privately owned portfolios in Colorado, and talk a little bit, I know you use, I think, all three REITs to manage your portfolio. Can you talk a little bit about how your portfolio is doing and some of the best practices that you've seen some of your operators implement at your stores?
Sure. Thanks, Ben. The first thing I'd like to mention is, the three operators that we're currently using, Extra and Public and Cube, have done an excellent job as far as keeping employees and customers safe. They spent a whole lot of time as far as making sure that all best practices were taken care of to prevent any transfer of COVID. So that's been a great and positive thing. And I think it's also given a little bit of reassurance to our customers that we are taking this situation seriously, and their products and their being at the sites are actually much safer than they could be otherwise. As far as our individual portfolio, what we've seen is, this looks very similar to the recession that we had in 2008, 2009, where we did see a, initial just stop in, rental units and rates essentially stopped and stagnated for a while. But in the last couple of months, essentially from May 1st till July 1st, we're actually starting to see growth at the facilities. And it's not significant. We're probably in the neighborhood of, 1 to 3% in that time frame. Our particular portfolio, we chose not to reduce our rates when this occurred. So, we may have missed a few rentals that way, but I think we didn't compromise any income. So, we're still trending upwards in certain situations. There's a couple sites that I've noticed that we have had some deficits, and those are primarily locations that there's new competition was brought into the market within the last year. And I think it's the slowdown in revenue in those locations are more a function of having to adjust rates to accommodate competition. So, like the other guys said, we haven't seen much of an impact. My sense, though, is as unemployment continues, I'm looking for probably a bigger impact towards late year, when unemployment really hits and finances are getting really tight for people. And hopefully we won't have that. In the past recessions, past issues, we've been doing this for quite a long time. We have seen storage have a tendency to maintain itself. And I think that's probably what we're going to be doing, for the next probably year, is we won't do dramatically better, but we will be able to maintain itself.
Thanks, Tom. I feel that all four panelists gave a great overview of how the Denver market and overall self-storage market is performing. So, I do think that there are some headwinds today in the self-storage industry, but I do think that the general consensus of the four panelists and the industry is that self-storage is doing better than most any other commercial asset. So we're very thankful for that. We're now going to shift gears a little bit and start to dive into some of the questions that we've received over the last few weeks. The first question that we're going to address is, with the disruption of COVID over the last few months, how are you pricing deals today when you're looking for acquisitions? And are you underwriting trailing operating numbers? Or are you still looking for year one growth revenues? And how are you looking at new acquisitions? Let's start with John, as I know William Warren's been active in the acquisition market over the last couple of years. John, how are you underwriting new acquisitions of stabilized stores today?
Sure. The first thing I'd say is that we're basically underwriting these with more conservative assumptions than we have in the past, which is a challenge because our equity partners are wanting to be compensated for the additional risk of the uncertainty, of what's going to be happening in the future. Nobody knows when. There's a lot more uncertainty on July 16th, 2020 than there was a year ago, I would say, with the vaccine, the virus, the economy shutting down, hopefully not again. But with those uncertainties, our equity partners are wanting to be compensated for the additional risk. And how do you make that work when you're having to underwrite much lower rent growth? So we are actually underwriting 12 to 24 months of minimal or no rent growth in our deals. And the other thing that we're seeing when we're underwriting is that you would hope that the expenses would be decreasing and you could find quality workers. But that, in our experience, has not been the case. I don't know if there's a lot of people sitting on the sidelines with the stimulus check of $600 a week that Hank was talking about a little while earlier, but so far we haven't really been able to get qualified candidates for what we would hope for. So with that being said, we're being a lot more conservative in our underwriting, but we're still actively looking for new deals.
Thanks, John. I think, there is an active investment market going on in Colorado. Joni Lucas and Cole Carosella, who are the Argus brokers here, have completed 3 transactions during the COVID disruption. And there have been some bumps along the way, but they are transacting and there is a market. But I think in agreement with what John said, where most buyers today are underwriting flat to no growth in revenue in year one, some as far as year 2. So moving on, we're now going to ask the group to talk a little bit about the new development deals. Over the last 3 years, we've seen a tremendous amount of new supply come on the market. And most of those projects are still in lease up. And I'm going to have Tom talk a little bit about, can you talk a little bit about how you're valuing new development deals today and possible new development sites along the Front Range in the Denver area? Are you still looking for sites, and how has it changed over the last 6 months?
So one of the things that we've done is we're still continuing to develop probably much more carefully than we would have, let's say, 3 or 4 years ago. Our biggest criteria right now is where is the competition and how much new product has been brought online in that trade area. So we have identified some areas outside of the Metro Denver area that still look fairly promising. The only downside of that is the barriers to entry are probably a lot less than we would see in the Metro Denver area. So, one of the things, we've always been very cautious as far as selecting sites. We try to select sites that are more of a retail-oriented location. So, it's just a function of, picking the right site. Talking a little bit about what John said, we're looking at the cost of construction to be coming down a bit. And some of the landowners that we're purchasing from, we're getting a few more concessions that we would have than even last year. But the biggest thing, and probably the foremost thing that we're using as part of our formula, is property tax and mill levy. We've actually walked away from several deals that the mill levy was just too great for a storage building to absorb. So we definitely are a lot more cautious right now. I think overbuilding and property taxes have really made an impact to our industry. And unfortunately, I think it will continue for the next several years. And I think that'll make a lot of development slow down quite a bit.
Yeah, I mean, I think, John commented a minute ago about having 83 development deals in the pipeline a couple of years ago. And, when I had lunch with John the other day, and I've talked to Jeff and Hank about this as well, we're only aware of 6 or 7 deals that are underway or in the planning stages. So I think it is happening. And I think your comment about real estate taxes, Tom, is meaningful. I think real estate taxes, along with the new supply, is really the tipping point of, this major slowdown in construction. The next question I'm going to ask is about distress in the market. As an investment broker for self-storage, I constantly get calls from investors looking for distress. And certainly, with all the new development over the last 3 or 4 years in Denver, we have several deals that opened in 16, 17, and 18 that are still in lease up. But can you guys comment a little bit about how much distress you think is actually out there today? We have not seen much distress from the brokerage side. Hank, can you chime in on that? I know you've been active in reviewing a couple opportunities like that.
Well, I've looked at things, and I don't see anyone really in distress of selling. It seems like a couple properties maybe gone back to the lender when the name has changed, but I'm not sure that the lenders have sold them. So then the question is, a lot of these properties were ill-conceived at pretty bad locations. So the question is, what type of investment do you want to have? What type of return do you need to take one that's probably a C or D location?
Yeah. John, do you want to add anything? I know you've underwritten some of those lease-up deals that are maybe struggling a little bit. How are you looking at those?
Yeah, I mean, with the part that we struggle with is how to grow the rates. And that's, when you're underwriting these deals, you can assume 20% rent growth, but when that's only 50 cents, and that grows to 60 cents, the deal still doesn't work. So that's a bit of an issue. So I think across the board in Denver, it really, not everywhere, but a lot of the places where the new supply is hit, like I said earlier, the facilities are leasing up. So you ask somebody how they're doing, and they say, oh yeah, we're 70% full in 2 years. But then the more important question is, at what rates? And if you're at $1, you're probably, $1.25, you're probably on the average. If you're at 75 cents, you're below the average, in my opinion. So, that's what I have to say on that.
Jeff, anything to add on that?
I haven't seen a lot of distress in the Denver markets along here. In some of the other markets that we're looking at, and again, going back to Hank's point, I think the distress is more because of new product and competition surge as opposed to COVID. But in other markets where we have been bidding on distressed properties, the properties are distressed, but there still seems to be buyers that are willing to believe in the story that's not unfolding in front of them. So even though the property may be distressed, the pricing that we've looked at anyway has not reflected that.
Yeah, there certainly is still more buyers than there are sellers in the space. And, there's certainly the argument that coming out of this the slowdown in the economy, this disruption, and that storage will come out looking better than most other commercial asset classes, which will actually make it more value. But let's talk a little bit more about rental rates, Jeff. How are you underwriting rental rates going forward considering the recent, I don't want to say drop, but fall off in rental rates across the Denver area? How are you? I know you've been very active in managing your rental rates and very successful. Can you talk a little bit about how you're handling the rental rates in your lease-up properties, Jeff?
Yeah, it is really a focus on trying to differentiate not only our product from you lock it, you lose it, but also, the individual units within our own unit mix. Just like the grocery store's got a can of white label beans, a store brand bean, and a gourmet bean. We've got a inside 10 by 10, an outside 10 by 10, a climate control 10 by 10. So we're looking for those kind of product differentiations. People that 6 months ago were charging $165 for their 10 by 10 are now trying to compete with Public Storage advertising a 10 by 10 for $49. It doesn't make a lot of sense for them to lower that $165 10 by 10 to $155 because they think it's going to compete with Public Storage's $45 price, So you've got to be able to find ways where you can compete, where you can put the loss leaders out there so that you still make the phone ring, so that you still get hits on the website. But you've got to lock into the fact that self-storage users use us because they don't want to rent the third bedroom. They use us because they don't want to rent a larger retail space. They use us because they don't have a better alternative to put their copper wire or their copper tubing. And so when you look at those other asset classes, we still have a relative value to residential and other commercial rates. And, residential rates are certainly holding very strong in the Denver market. And so our base value, really hasn't changed. So it's just the way that it's marketed at this point in time. So if you can kind of remember that, hey, we're worth it, go ahead and ask for it, and put a few things on sale. But, it doesn't make any sense to put your whole store on sale just because you want to have another 2% in occupancy and you're willing to sacrifice 20% in revenue for that. It doesn't make any sense to spend that much money on your rates when you should be spending it on your advertising.
No, I agree with you, Jeff. And your comment about unit mix, I think that that's something that we've seen in the investment advisory world recently is that, most of the product that's been developed over the last 3 or 4 years, multi-story product. And we're really seeing a premium paid actually for the single story product today, much more so than we did during the last 3 or 4 years, that we've seen more buyers looking for the drive up units. So differentiating yourself, I think, is really important today. And I also like your comment about, comparing this, people don't want to rent that third bedroom. And there's certainly been a surge in home remodels during the pandemic and other people, fixing up their homes or using that other bedroom as a now home office. So I think that it is still a need-based business. And I think there's some things going on in the world that are actually creating some demand for self-storage. So that's a positive, I think.
You're talking about the multi-story and single story. I really believe that it has to be a mix. And unfortunately, a lot of the new products were just multi-story. They're able to perform higher rates, lower unit size, average unit size. And that's why I think we've got this problem where we have mostly more multi-story, and that's kind of what the city's wanted for zoning compared to a mixture of multi-story and single story. So I think that's why we're in the situation, today. And the pricing can be a little bit more aggressive on, the CBD area, single story, because there really is not much available.
Yeah, we've recently transacted a store in the Denver CBD area for, sub 5.5 cap. That was single story drive up for that very reason. So I think that's all good. The other thing that I would comment a little bit, as you guys know, Argus, we have a management company, is we've seen that, controlling operating expenses is much easier at the single story level opposed to the multi-story. It's a lot easier in these challenging times to cut operating expenses than it is to raise revenue. And those stores seem more conducive to that. But let's talk a little bit more about investment markets along the Front Range. We've seen this disruption kind of go from the CBDs out, it appears. It certainly seems that secondary and tertiary markets were less affected by the COVID disruption, and values are relative to that. Do you guys feel that small markets are less volatile than major markets today? And if so, how much higher of a cap rate are you guys putting on smaller markets? Typically, I know Denver, if Denver was a 5 or a 5.5, the western slope was 150, 200 basis points higher than that. Jon, can you comment a little bit about, I know you've looked at a lot of different markets, how major market cap rates are comparing to secondary market cap rates today, and what the spread is?
Sure. Yeah, I can speak to that a little bit. I actually just got off my first plane since the pandemic started last week. I went to see a site in rural Washington, outside of Spokane. So it's kind of falls right in line with this question. And we're basically looking about 100 to 125 basis points higher in those cap rate higher in the secondary, tertiary markets. The reason being, still the equity, the equity money generally wants to be in top 25, top 50 MSAs. I would say that there has been a little bit less volatility, but one thing that we're really focusing on at William Warren is university towns. And it's not necessarily the student activity that drives us to those towns, but more the economic, the R&D, and all of the, it's a stabilized market from an economy perspective where the university is a stronghold. For example, Gainesville, Florida is a market that we really like. Fort Collins is a market that we like here in Colorado. So those type of markets are something that we're taking a hard look at, much more so than we have in the past for those reasons.
Tom, you got anything you want to add to that comment?
I think I think there has been a focus recently as far as going to secondary markets. The other thing that we talked a little bit earlier, Ben, about some of the issues in short sales and stuff. We actually have seen some developers, and the primarily new developers to Colorado, that are having to sell facilities at less than what they're into it for. And the unfortunate thing is, in the Denver metro market 2 years ago, the demand for new product was so high, according to developers, that they were building products for in excess of $100 a square foot, and those can't be serviced with the rents they're getting. But as you go to a secondary market, really all your costs are down. Your land costs, your development costs, your construction costs are down. So even though you have a higher cap rate, your basis is less, and so it's still a very good investment. The only downside is barriers to entry, like I talked about earlier, is a little easier, so you may have more competition in the future.
Yeah, I think that's a good point. I think, part of the premium that the top 25 MSAs demand, the reason for that is the barriers to entry that Tom mentioned. It takes longer, it's more expensive, it's more complicated development. And I also like Tom's comment a little bit about, the localized nature of our business. And that really speaks to the developers. All four of the panelists on here live in Denver, are active in Denver. They understand the politics. They understand the good areas, the bad areas. It's very easy for what I would call these merchant developers from out of state to come here and make a mistake. So I do think if we're going to see distress over the next couple of years, it's going to be from developers that have entered the Denver market that might not have spent the time to fully understand it. Lastly, we've got a couple more questions here, but, I think this next question is really going to, be a hot button, and it has been for the last several years, and it's about real estate taxes. Real estate taxes in the self-storage space has been, certainly in Colorado and Denver, has been the fastest growing expense line item, and sometimes it's a multiple factor of several times. But, how are you guys looking at real estate taxes differently going forward in certain counties and certain states? I heard Tom talk a little bit about mill levies. Is there anything that you guys would warn everybody against with regards to how to underwrite real estate taxes? Or how to combat them. Hank, can you talk a little bit about this? I know you've really led the charge at COSSA, trying to figure out ways we can better serve our membership by trying to educate some of the politicians about the fact that we can't have $300,000 and $400,000 real estate tax bills at some of these properties.
Right. Well, it's going to be up the road in November this year about repealing the Gallagher Amendment. And the question is what impact that's going to have. I think there's two different amendments that are happening, and it's not going to really be detrimental that much to the residential. I think it will keep it then at the 7%, and we're at 29%. They won't go lower than 7%. And with the Gallagher Amendment still in place, it might go to 5%. So overall, I think it's going to be tough on all commercial property owners and the state of the economy in Colorado for education. I mean, that's why everyone's looking to repeal it. It's a bipartisan amendment, and that's what they're looking at because of the education. You know, now with the virus, I'm not sure exactly how any bills are going to be able to get paid for schooling on that. So I think everyone should keep an eye and try to figure out what's the best for our business and the state of Colorado for this November amendment.
Yeah, do you know what amendment it is, Hank?
No, I don't know. It's a repealing of the Gallagher Amendment.
Okay,
No.
we'll follow up with that information. I think it would be good for all of us at COSSA to review that amendment and think about what's the best thing for not only our business, but also the state. Jeff, do you have any thoughts? I know you've worked on the real estate tax part of things in not only Colorado, but other states. Maybe you have any words of advice or guidance for us on how we should handle the current situation we have in Colorado.
I think that it's a good thing that the board, you know, the COSSA board has really been focused on this for the last several months, and you know, Hank has been a big proponent in us being involved not only in the repeal of Gallagher, which is critical not only for schools but also fire districts, you know, watersheds, everything else, all the local districts that benefit from property taxes. But it's important that we continue to stay involved with what replaces it. If it gets replaced, you know, as Hank was saying, the amendment comes with a legislative input of you know, at least freezing property taxes, you know, so that in this first year anyway, they're not going to go up. And so they're going to figure out a way to continue to increase property taxes on commercial product. I think one of the things that we have to look at is to how to help Colorado expand the definitions of various asset classes. You know, self-storage is not a triple net lease like most other commercial properties. You know, how do we better define self-storage in whatever it is that comes forward to replace Gallagher? And I think that's where COSSA needs to continue to be significantly involved. The only thing that we're considering as far as property taxes is that in a lot of deals that we've done in the past, you can look at the mill rates, you can look at the assessments, and when you buy a property, in the past we've been able to say, you know what, we're probably going to get some kind of a break here because you know, the assessor is not going to go from, you know, an $80,000 property tax bill to a $250,000 property tax bill on this asset. That's what we used to think, but that's not what's happening now. You know, I mean, you really have to expect that those assessors are going for everything that they can get, and you know, they sit back on the law as the law. So continue to appeal, continue to look forward, but expect the worst when it comes to how you're underwriting new properties and new acquisitions.
Now, does John or Tom, do you have anything you want to add to that conversation?
The only thing I have is, you know, I think for a long period of time, the assessors may have undervalued self-storage, and I think they may have been a little bit too aggressive to catch up. And the storage buildings themselves, the revenues can't keep up with the new tax assessments and values. You know, I've seen deals where property taxes are 25 to 50% of the gross revenue. And, you know, after you take out other expenses and debt service, you're essentially treading water, if not losing money on these deals. And like Jeff said, you can't transfer the cost to a tenant. And, you know, we have other assets, and even those that we're trying to transfer to tenants just can't afford. So it's really impacting the commercial industry and the commercial development industry.
Yeah, I think, you know, your comment a little bit about maybe being too aggressive. I think there's probably a lot of people on the call today that feel that the assessor has been too aggressive. And I think, you know, to speak to Jeff's comment a little bit about the new Gallagher Repeal Act, is part of what comes with that is a freeze in the real estate taxes. And I think you're giving, you know, if we are able to do something with Gallagher, you know, we've got to be comfortable with, you know, where our taxes are today, because you're giving up the ability to go back and protest them and get some sort of reduction. So I think that that's all things that you guys really need to focus on. And, that's the other thing that I think is going to slow down new development in Denver is, gone are the days where you can go build a $7 or $8 million property and have it assessed for $4 or $5 million. I think Jeff and Tom's comment about you really need to prepare for a full assessment is that's really what's happened in our industry over the last several years. One thing that we've had success with, and most of the sophisticated buyers out there is deal structure when you're buying an existing asset. There is a business enterprise value that comes with self-storage. The ability to operate the business, non-competes, et cetera. So if you're looking at buying a facility, you might want to talk to myself or any one of the panelists about some sort of price allocation between real estate and goodwill and non-compete business enterprise values. We've had some success with that. We're bumping up against the 45-minute mark here, and we don't want to take too much of everybody's time. So we've got an opportunity for two questions here, and we have a couple questions that came in, but I'm going to ask somebody a question that came in here is, how do you guys feel this disruption of COVID and all this stuff will lead to more properties transacting in the next 6 to 12 months or less properties to transact? Jeff, why don't we start with you? Will there be more properties on the market or less?
I think it's going to be similar, just like our own customer activity, move-ins and move-outs. I think the whole economy is kind of in this same pause mode. I don't expect it to change much at all. If anything, it's going to be tamped down a little bit.
John, do you have any thoughts on that?
Yeah, I do. I think that, like I was alluding to earlier when I was talking about how we've been underwriting things and how it's kind of come to a stalemate in a lot of situations. I think that there will be more properties transacted on after this subsides, because I think that everything's kind of, even though not officially on hold, it's not like gung-ho like it was 12 months ago or 24 months ago.
Tom? Go ahead, Hank.
I think you're going to see the transactions based on what happened overbuilding a couple of years ago. I mean, and the virus, what it affects today is really minimal on our economic, feasibility of the properties.
Yeah. Tom, do you have any thoughts? Do you think we'll see more transaction velocity or less?
I think most people are going to wait and see as far as acquiring new properties. So I don't think I think it'll just basically be flat. But I agree with Hank. I think the impact is people that are in trouble because of overbuilding more so than the COVID issue.
Yeah, I agree with you. At Argus, we've actually seen an uptick of what we would call entrepreneurial deals or mom and pop deals. Those are $3 million and less. We've seen more of those listings come on the market in the last 60, 90 days than typical. But, the more sophisticated operators like the gentleman on the call today are certainly understand that self-storage is going to weather the storm probably better than most asset classes. And, I get that comment all the time, what am I going to do with the money? And today, I got to be honest with you, I would not want to be in any other asset class besides self-storage. So we'll finish the call here and ask, all the panelists to comment on one question. And it's a question that as an investment broker, I get all the time, but do you feel cap rates are going to go up, down, or stay flat over the next 6 to 12 months? Let's start with Tom.
I think because of the uncertainty, I think things will just stay flat until we get a real focus on how unemployment changes, really the whole economy.
Okay. Jeff, I saw you got something out of your cabinet there. What do you think, they're going to go up, down, or flat?
It's got its crystal ball.
I don't know.
John?
Well, Wall Street Journal just reported mortgage rates just got a new low of 2.98% today. So I think we're heading down.
Yeah, John?
Nationally, I think that they will increase slightly. This is assuming that the COVID issue 12 months from now is somewhat resolved. 12 months from now in July 2021, my guess is cap rates are slightly higher on a national basis because the new supply hasn't hit the major markets like LA and New York and some other places, parts of Florida. Versus here in Denver, I think that they might be flat to slightly lower because I feel that the new absorption, we were banking on 2020 to be the year of Denver climbing out of the black hole, and then the pandemic hit. But I think as more population outpaces the new supply in the metro area, I think that will drive rates up and therefore cap rates down, rental rates up, cap rates down.
So, you know, we've got a flat, I don't know, an up and a down. You know, it's all over the board. I don't think anybody does know. So we covered all our bases there, guys.
Right.
You know, my thought on the cap rate valuation thing, and I'll just share this with you because I've given quite a bit of thought. I don't think cap rates are going to move much. Yeah, you know, 15, 25 basis points up or down. But one thing I do think is the values are being impaired by the performance. You know, so even if cap rates remain in the 4 or 5% range, the softening in the performance of the asset is going to have a more meaningful impact. And as Hank said, you know, interest rates are still really low, and therefore I do believe there will be some transactions between now and the end of the year. But as I mentioned a few minutes ago, we are over a 45-minute time target, and we do want to be mindful of everybody's time today. I know we didn't get to everybody's questions. We will follow up with everybody after the call and get you feedback on all your questions. Thank you all for your participation. This now concludes the Colorado Self-Storage Association's investment Q&A webinar. I want to thank everybody for participating. A recording of this webinar is available. If you want to reach out to me directly or to the COSSA, Maggie at COSSA, or any of the board members, we'd be happy to get you a recording of this. Thank you all very much and have a nice afternoon.
Thank you. Be safe.
Thank you.
Thank you.
Thank you.